Well, hello everyone. This is John Byrne with Poets and Quants. Welcome to our Faculty Spotlight series at the Gies College of Business. Today we have a financial guru with us, someone with a long career in the corporate and finance sector, who has been teaching finance at the Gies College of Business. Richard Excell. Richard, welcome.
John, it's great to be here. Thanks for having me. Looking forward to the discussion.
So, I looked over your resume and I'm thinking, wow. You worked at SBC, First Chicago, Barclays, UBS for many years. Um, and then you even had your own firm. So you have a lot of experience trading, among other things. And I wondered, how did you become an academic? Why'd you take that turn?
It was not my plan. Let's put it that way. My parents were teachers, and so we rarely want to do what our parents do, right? So, yeah, I spent the first ten years of my career on the sell side, in investment bank sales and trading. That back then, that's when investment banks could take a lot of risk, well before the financial crisis. But I navigated to the buy side in the world of hedge funds, and so I got to do that, and it was phenomenal. It took me all over. And then when my middle child went down to U of I in 2016, at an event, and I connected with Jeff Brown, I think our former dean,
Sure.
and I was sharing some of my opinions about how he can improve things, and as Jeff would do, like, how do you want to help? Well, you want to come down and talk to the students? You want to teach, whatever. And I just came down and started talking to classes. I did that for the first year, and then I worked on practicum projects where we the practicum is where we go out and get real world projects, research projects, others from companies to have the students work on, and I was the client, so I was the one kind of coming with those research projects, and I did that for a year and a half. For a year, I did it a couple times, and then they wanted to do it in the spring, but they didn't have any faculty to do it, and so they said, "Well, hey, you've done this a few times. You've run a number of projects for us. Would you mind running yours and some other projects too?" And so I did, and that went well. And then they're like, "Hey, this fall we have an opening to teach portfolio management. What do you think about that?" And but it was like that the frog in the pot of water slowly turned the heat up, and before you know it, I was teaching two classes a semester while I was still working. And then after a year of that, I just said, told my wife, she's like, "You always take on more than you can take on anyway, but you seem like you're really you're really spread pretty thinly. What do you want to do?" And I just said, I think I just want to focus on teaching because I'm happier after a day of teaching than I am after a day of chasing around the markets and getting yelled at by investors and having to deal with regulators and all these things. It was my 30-year anniversary in the markets, and so it kind of it was a nice place to put a bow on my on that part of my career and move into the next and move in full time, and I did. And I'm now in my seventh year, and I love every day of it. I had a student the other day ask me what's my favorite job I've ever had, having had the opportunity to live and work in many countries in Asia and Europe, buy and sell side, et cetera. I'm like, I honestly think the current role that I have is the best job because I get to do everything I love about the financial markets, which is trying to navigate them, trying to figure them out, trying to, talking about them with people who are smart, who like to talk about them. But I don't have to deal with all the things I didn't like about it, right? And so I think from that standpoint, the classes that I'm able to teach and the discussions and I have with the students is just really a fun thing for me.
Plus, you're really good at it. I know that you have won an award for teaching at the University of Illinois, which is no small feat. I always think that as important as research may be in a business school, the truth is that a teacher has a remarkable impact on people, and people who can convey ideas convincingly and well have a lasting impact, an enduring impact on the people who graduate from the school. That's been true for me, and I'm sure it's true for many of your students, given the award that you were given by the university.
Well, I hope so. I try to put my my full efforts and my passions into it, and hopefully that comes out. And I've had some success with students wanting to take more than one of the classes and students staying engaged with me even after they graduate. So that's funny. When you talk about that impact, I remember the head of the department. I told him like the first time we sat down for breakfast, and I said, there's something you said to me in class 30 years ago. I don't know if you remember it, and of course he didn't. But I'm like, to your point, things that you say can stick with people much longer than you think.
And you recently started with a colleague a derivatives and trading academy, which is three core courses in this area. How come is that become derivatives are becoming more popular even after, the big financial implosion not too long ago over derivatives?
Yeah, so I do the Derivatives and Trading Academy on my own. I do the Investment Management Academy, which I also run. I run that
Oh,
with a colleague. But I started this, and when I came back, when I started teaching full time, Lewis Chan is the head of the department. Said, what do you really want to do? What do you really want to do? This is what we need you to do. What do you really want to do? And I said, I would love to just teach a lot more derivatives curriculum. We had I think one core class and a case study class that were being taught. But I'm like, there's a lot more that's going on. The world has really evolved beyond the kind of the basic derivatives. There's a lot of really interesting things that are going on out there, and I think Chicago has always been the hub of derivatives with the exchanges, et cetera. Like it's just I felt like it was we weren't really kind of presenting our best face forward. And of course, as you know, I mean, oftentimes those elective curricula is a function of what the faculty wants to teach or can teach,
true.
right? So Lewis gave me the chance to do it, and the academies are a core part of what we do in the undergraduate finance curriculum, and I saw a lot of demand from the students for for these derivatives and trading classes. That there's a chance for them, and then we had the plus data science major come in where students could be finance plus data science. And so now they were starting to have the quantitative background necessary for the world of derivatives. That those derivative firms, came down to recruit in what was wasn't Gies then, but our College of Business back in the day. That's how I got into that field. But they had moved to go into our engineering and computer science schools because that's just the way the world had moved. Now our students in Gies have a strong quantitative background too. I can couple that with their interest in the markets, talk to them about kind of how to model, how to price, how to think of those things, and then of course a lot of what we do is experiential learning. So bringing in trading simulators and professional trading software so that they can learn to use that and be ready to go in the real world. And when I talk to companies about that, about saying, "Hey, what do you think about this idea?" Because I always want to see if there's a market out there, if for
Mm.
this, and, and they love the idea because I think they were seeing two things. One, they were seeing that hiring pure quants, they know how to answer a question very well. The problem is they don't necessarily know what question to answer, right? Whereas people who have that interest in the markets have maybe a little bit more intuition about what are some of the questions that need to be answered. And so the combination was pretty powerful. And it was just kind of a question of getting people over the hump, getting to kind of pass some of the qualifications, if you will, of being preparing them, and we're in our second year, and it's worked very well from a student standpoint. The companies are loving it and want to engage more, so it's really fun. I think when you talk about that whole notion, I know after the financial crisis when Mr. Buffett called them financial weapons of mass destruction. My point is like derivatives and options, et cetera, are nothing more than insurance policies. And it's the nice thing about it is it's insurance policies you can buy or sell. Now,
Mm.
derivatives inherently are not dangerous. How you use derivatives can be very dangerous. And so let's learn to use them the correct way. And so I just kind of try to broach it from that angle and show people that there's a framework where you want to think about both sides of it and understand some of the risks, but also understand some of the opportunities.
Now, these are advanced courses. I'm assuming that the people who take your courses know that they want to specialize in the area of finance. So I wonder, when they come to you and they're getting deeper into these subjects like derivatives or wealth management, investment management, what misunderstandings do they have about the fields that you try to write?
I would say and through no fault of their own. It's kind of the idea that if you have a hammer, everything looks like a nail, right? And
Mm,
so we teach them financial modeling. We teach them DCFs, three statement models, things of that. So once a student learns a DCF, they think that they can solve pretty much every problem with a DCF, and it delivers this intrinsic value. And it's the way they learn it. And of course, it's difficult. It's the table stakes. You have to know those things to get into the industry. Um, but it's not some sort of mathematical construct or answer key. It's an idea. It's the right answer based on all the assumptions you put into the model. So what I try to then get them to that next level to think about is, okay, you've figured out how to answer the question for a given set of assumptions. Oftentimes, those assumptions have been given to you by your professor. Now let's figure out how to come up with those assumptions, and let's figure out how that answer is going to change for that set of assumptions, because that's what we do in the real world on an everyday basis. And I go back to all the way right when I started in the industry. I was trading in a foreign exchange market, and I remember vividly, actually, and even though it's that many, many, many years ago, last century, as they say, I remember the Federal Reserve cut interest rates, and I was watching, in the foreign exchange, and the dollar got stronger, dollar went up, and I scratching my head. I'm like, how could that happen? I know I learned about interest rate differentials in the foreign exchange market. This doesn't make any sense. And one of my mentors pulled me aside and kind of talked to me about how markets move at the margin. Markets move based on what's expected, and not what happens. And it's really the kind of the idea of that. And think about relative to expectations, thinking about, what are your assumptions and things of that nature. And that's what I try to like really help them understand, is that there's nothing that says something absolutely must happen. It's really kind of comes down to how the news comes out based on how people are perceiving it will come out, which is more art than science, right? And isn't it
true.
nicer to have the science of it? It's poets versus quants, right? To stay
That's
on
true.
brand here. You have that idea. Like, I've got this model though. It gave me an answer. Like, okay, and that's really nice. Now let's kind of change some of those assumptions and see what your model says now. And I think when the light goes off, as it tends to do by the end of the first or second semester, have them. I think that's when you start to say that they're cooking with gas, as the kids say. It really starts to get a little bit more fun, and I think they really see where the opportunities can present themselves.
And for all of those out there who do not know what DCF is, I'm going to just tell you it's discounted cash flow analysis, which is a core concept that you'll learn in business school. Now, Rich, I wonder what you've learned. You spent all these years actually doing it and making it happen. And now as a teacher where you're teaching it to others, I'm imagining that you look at it maybe a little bit differently because there's some distance involved. And I wonder if you've had learning as a result of the change in your role.
No, I think what I don't know if I learned something different. I think it's maybe solidified some of my perspectives, shall we
Hmm.
say? And I
Yeah.
think I've had the benefit. I've had the benefit, as I said, I've had a chance to work in pretty much every asset class, and I've lived and held green cards in five different countries. And so definitely benefited from seeing a lot of different perspectives on how people view the markets. And the finance is the same everywhere, right? It's cash flows and discount rates no matter where you go. However, back to the idea of assumptions, the perspectives, the regulations, the demographics, what people care about in each of those countries, in each of those asset classes are very different. And so to learn to become much more pragmatic and less dogmatic about things, through time, et cetera. And I think as I come in and I see from the students, I see a different perspective. I see a different generational perspective. We have the benefit of students from all over the US and even all over the world. And so I'm seeing different perspectives even within my class from different students. And so I think that reinforces that idea that there's a lot of different perspectives, a lot of different reasons that people might choose to say yes or no, buy or sell, et cetera. And I think that kind of consistently reinforces itself. And I also think that the other thing that I've kind of sensed a little bit more is just the idea that I don't know if everyone has a full appreciation for maybe the more technical aspects of the market structure and how and why money moves on any given day. And I think that's something that I'm still learning. We're all still learning because the structure's changing all the time, right? But I think that that's kind of putting together that part of the mosaic is always interesting and is always ongoing for sure too.
And your role as a professor harks back to the days when you were an undergraduate student at the business school at the University of Illinois, and then you got your first job as a derivatives trader in 1990. I wonder if you think markets today are as efficient as they were when you first went into the business way back in 1990. Are they as efficient? Are they more efficient? Are they less efficient?
I would argue they're probably more efficient, if anything. And I think I would say that from the standpoint of as the really in the post financial crisis world, as quantitative finance, systematic investing, et cetera, has really come in, the abilities and for people and the computational power that we have and everything these days, the ability to analyze data at scale and to deploy those ideas at scale, takes out that arbitrage opportunity very, very quickly. You can codify and make sure there's no arbitrages, right? And early in my career, not, by 1990, a lot of those arbitrage in the options market were already gone because the firm that I started with, O'Connor Associates, was really good at getting rid of them, and they've been in business for more than 10 years. And so there weren't very many then, but I think I think there, we've seen that across most things that those are gone. But I think that kind of creates different opportunities because now you've got, that random walk, if you will, is
Mm.
is a different walk because it's now got more of that positive drift from flows into passive vehicles with more of a step function when there's a change in opinions around fundamental events. That information doesn't necessarily it doesn't leak into price the same way because of that positive drift. But I think the market might talk about it, but there's, if you're an active manager and if you're a hedge fund manager now, you can't fight that daily drift of money from the 401ks, just kind of taking stocks higher every day. You have to be tactical and wait until the right time. And so I think before you see more of a momentum factor to it, and then you see bigger moves. So I think you have to be more tactical than you have to be than anything else. So I guess I'm dancing around it. I do think that there's more information because we have more data, and so things have gotten more efficient. But I think there's probably also equally as much behavioral biases in the market now as ever. And I think that's probably a bigger thing. So I guess it's a kind of a combination of the two, and it depends on your horizon, I guess.
Yeah, exactly. Now, I wonder what do you most like about teaching finance to students?
I love the optimism. I said I spent 30 years on Wall Street or the equivalents around the world, and you find a lot of skepticism, if not cynicism, right? You become
Indeed.
very skeptical, if not cynical, and so the discussions I have are so much more upbeat and optimistic. And even when we're talking about difficult times and how the job market doesn't look that great or how can this happen in this just geopolitics, et cetera. It's always with that view towards, okay, how are we going to fix it and what's it going to look like? How's it going to be better on the other side? Whereas I think when you work with the people of my level of age and experience, I don't think they're as worried or focused on what the good outcome is on the other side. They're more focused on the bad outcomes, and that's just a learned behavior. It's like everything. As you get older, you're willing to take fewer risks, right? And I'm not saying that they're risky, but I just think that I just love the optimism that they have and the way they see more opportunities. Now they've got to anticipate more risks, and I think needs to be a balance between that risk and opportunities. And I think early on people see the opportunities and later on you only see risks. And so I think it helps me stay balanced because I'm that type of person that normally only see risks. And so it really helps me open my own mind to say, okay, well, what are the opportunities here?
And when you're involved in the market, I mean, there are good days and there are bad days.
Yep.
Can you recall the worst day you've ever had during your career trading? Like, what was the biggest loss you ever had, and how did you deal with it?
I can remember it. I regale this story to my students whether they want to hear it or
I'm
not.
sure.
That's what my kids like. You're teaching so you can tell the same stories you've been telling us forever, right? I'm like, yeah, pretty much. Um, I was trading foreign exchange and I was trading the over-the-counter market, and was working in Asia, living in Singapore, and it was 1997, and with foreign, all the rage these days is 0 days to expiration or zero DTE options in the market. But foreign exchange has always had that. We've always had daily expirations. In fact, twice daily expirations. And so even going back to the 90s, and I remember I had a large options expiration the next day. And then in like the middle of the night, my boss who was in London called me up and said, by the way, Thailand just devalued. Their currency is down 30%. It looks like you're going to be down $25 million when you walk in tomorrow. So make sure you get a good night's sleep. Um, and of course, I'm what I'm, I'm looking at, I'm like 29 years old. I'm thinking I'm having a heart attack. And I'm like, this is, of course you can't sleep, right? Um, and sure enough, I lost $25 million the next day. There was not too much I could have done about that, but you learn from that. And, I tell them like that, you learn from that. You don't make those mistakes again. You realize that even the most low probability events are things that you want to potentially consider hedging in some way, shape, or form. And the happy part of that story is that by the end of the year, I've been able to be learning from that. I've been able to make all of it back. And so there was a happy ending from it. But that day, that night was not very good, and I didn't know if I was going to make it.
It's a roller coaster ride, isn't it?
It is, and I tell them like you have to like if to go into this business. I mean, and in trading and investing, there's similarities and differences. There's just more of a duration issue, but you're going to be wrong a lot, right? There's millions of people, millions of the smartest people in the world, all with this same level of skill and talent that you have, all trying to do the same thing. And you're going to be, the best traders and investors are right about 40% of the time, regardless of whatever you read on social media. The thing is, the best ones have good risk management. So when they're wrong, they only lose a little, but when they're right, they make a lot. And so that's what really helps them compound over time. Um, it's not that they're right more often than other people. They're wrong a lot. And it's hard for people who are used to getting 90% plus because they've gotten A's most of their life to go into a
Right.
job where you're wrong most of the time. And I think that's why a lot of people burn out very quickly, even though they say they want to get into the world of hedge funds or whatever. And you're like, okay, they flame out because it's hard to be told you're wrong all the time and still want to have that grit to get back in there and say, okay, I'm gonna outsmart the market today then though. And you need that grit, and it's a you need to have that kind of personality trait to want to do that.
Indeed. Rich, it's been a pleasure.
John, I really appreciate it.
Hey, thank you so much for joining us. So, we've been speaking with Richard Excell, a finance professor at the Gies College of Business. This is part of our Faculty Spotlight series. Check in for other episodes. This is John Byrne with Poets and Quants.